what I'll do today is I'll work it through the day. We'll do another one on Thursday, depending on how Thursday goes. The exam's not until the week after next. So we have next week. If y'all do well on Thursday, we probably won't do another team competition on this. If you don't, we'll do another one because I really want y'all to do well on this. I actually want everybody to do well, not just the team members that are leading. So today I'll do it. What I'll do on Thursday, if a team volunteers, I'll grade theirs if it's on grading your exam. So if we have a team volunteer on Thursday, I can do that. But today I will just walk through it. Remember what you do here is you start off with the environment. So y'all remember some of the things that you have in this list? What's one of the things you're looking for? Inflation is going to do what? Going up, coming down? Coming down? What else? Yeah, interest rates, rising or falling? Rising. What else? US dollar strengthening. What else? What's the most important one? You start off with what? Economy. Yeah, you always start with economy. We talked about that at lunch today when I was talking Victory Capital.
Oh,
What's the economy going to do? Mild recession. Does the word mild mean anything? Yeah, I mean it's there. If he said if they said depression or serious recession, that would maybe make you even stronger in your opinions, but it really doesn't change the overweight, underweight, just the degree. What else? What else do you need on interest rates?
volatility.
Are they gonna be volatile or less volatile? More volatile? They said something on spreads. What do they say on spreads? Widening. That's good to know when you're trying to pick between corporates and treasuries. They tell you anything about international markets? Anything about developed and emerging? Not so much slowing down because US is also slowing down. What's the key here? We're talking about relative. Weaker than US. Do you all agree with that? That's important. Because remember, you're going to say within stocks. So within stocks, you don't like any of them, but you like the US better than developing emerging. So that weaker is an important term. You can't just say their economies are weak because so is the US. Anything on alternatives?
I don't understand how you evaluated the interest rates because it says the Fed will cut rates like much later in the year, but also the interest rates are going to rise.
All right, so the Fed is not interest rates. The Fed is only the short side. Usually when we're saying interest rates, we're looking at the 10-year or longer. So what's the yield curve going to do? Steepen or flatten or invert? So short rates can come down, long rates can go up. What's the yield curve doing? It's steepening. Okay. Something you could look up, I think, Luke's a good point to bring up. I don't know if we talked about this before. Have y'all heard these terms before? A bear steepening, a bull steepening. So bear means what? Bond prices are falling. If bond prices are falling, what's happening? Rates are doing what? They're rising. A bull is bonds are doing well, which means rates are falling. So can anybody guess is this scenario a bull steepening or a bear steepening? So a bear steepening would be short rates are falling, long rates are rising. A bull steepening would be everything's falling, but short rates are falling more. So is this a bull or a bear steepening? It's called a bear steepening. Why? Because long-term rates are rising, long-term bonds are going to be crashing. So you can look that up and Google bear steepening, bear steepening, bull steepening. Bear steepening yield curve. Bear steepening is when yield curve widens due to long-term rates rising. What's a bull steepening? when short-term rates are falling. Short-term rates. So what they're talking about, so this is a bear steepening because short-term rates are falling, but long-term rates are rising. So it's steepening because the long end is going up. It's not steepening because the short end is falling. It's steepening because the long end is going up. All right, what did he say? What did I say on alternatives? Mod, real estate. So we have our picture. So you start off, we need 18 things. The first one's not on the list. So what's the very first one? Yeah. So what do you recommend there? Overweight. Which one? Bonds, especially higher quality and underweight stocks. So we got one. All right, treasuries, how many bullets here? Two. So we're going to overweight or underweight? Overweight as what? Which of these tell you the overweight? Short-term treasuries. First two, right? Mal recession, rates are rising. So the way you can word it is overweight as expect recession, so want quality. You don't have to give me a long definition that treasuries are full faith and credit by the federal government. They can print money, so they're high quality. You don't have to explain. I know treasuries are high quality. For this exam, you can assume I know treasuries are high quality. So the key here is the why. Don't just say overweight. You say overweight, that's the correct answer because it's zero credit. You have to tell me why. So overweight as expected recession, so want quality. What's the next one you want? Overweight as need short-term as what? Rates are expected to rise. You don't say overweight because rates are high, because that would be wrong. It's always about the future. They're expected to rise. If they're already high, it's too late. You should have shortened a long time ago. But because they're expected to rise. All right, we're up to 3. What about tips? Overweight, underweight, underweight, inflation falling. That one's an easy one. We're up to 4. Mortgage backs. Underweight, why? What do you want to do? Buy convexity or sell convexity? Why? Because rates are expected to do what? Be volatile. Now, if rates are going to be stable, there you say overweight. You want the sell convexity that is buy mortgage backs because rates are expected to be less volatile, and you want to pick up that extra yield. So always remember that. If you had a choice, it's a choice between treasuries and mortgage backs. If their yields are the same, you just buy the treasuries. There's no reason to buy the mortgage backs. The only reason you buy the mortgage backs is when rates are going to be really stable, you get to keep that extra yield that you got when you bought the. You don't say that on the underweight side. You just say you prefer them because rates are going to be volatile. All right. We're up to 5. Now look on this next one. You combine them into how many things here? 3 things. 2 of them are the same as treasury, so that might help you. So these are medium quality. What do you want to do with them? Overweight or underweight? What tells you? Well, on treasuries, we talked about quality, recession, and interest rates. So let's start with quality. What are these? High quality, medium quality, low quality? Medium quality. I would say underweight as expect recession. So prefer higher quality. Underweight, what's the second reason? As expect rates do what? Rise. So prefer shorter term. And what's the last one? So between munis and corp, prefer corp because tax adjusted yield 0.045 divided by 1 minus what? 0.2 equals 5.625, which is lower than 6.2%. So the muni tax adjusted yield 5.265 is lower than the corporate 6.2%. There's your three things. That's one of the two places students lose most of their points. So you want to underweight, but you're not going to go to zero. So the amount that you have a choice between munis and corporates. That amount, so maybe you normally have 40%, you're going to cut back to 30%, but in that 30%, you're going to skew more towards corporates and away from municipals. Might you say, well, spreads are widening, but these are the same quality. Now they don't move exactly together. I have a municipal bond portfolio and I have a corporate bond portfolio. I'm surprised some days they do not move together, but over the long term, they do generally move together. There's some days where my tax exempt doesn't move a penny and my corporate's down 5 cents. And I'm like, what the world's going on? I was at lunch with those guys today. I should have brought one of those and asked them about it. What's going on with the taxable? My best friend actually manages one of my mutual funds. I should call him. All right, questions on that one? See, it helps you to think the first two are exactly what you did with treasuries. You just got to change the words for municipals and corporates. And you see, you don't have to talk about municipals, you don't talk about corporates, you talk about them together. You can put those two together and talk about them together. And then your last bullet or your first bullet, comparison between each other. All right, high yield's the easy one. What do you say there? Underweight, as expect, recession, so we want high quality. Some students forget what junk bonds are. Junk bonds are the lowest quality bond there is. So you definitely don't want those. We're up to number 9. We're halfway there. All right, how many bullets here? And how many here? 2, unless you, depending on how you word it. All right, so large cap and they're defensive. So first 2 words, anybody remember? Within stocks. What are you going to do? Overweight or underweight? Overweight as expect what? Recession, where large cap will outperform small cap. Now, if you say that, you essentially got that bullet and this bullet. You can get it all in one, but to be safe, I would do it twice. Within stocks. So here we're going to say overweight. I'm going to actually say overweight large cap. Here I'm going to say overweight defensive as expect recession. Small cap, just the same. You don't have to say within stocks. If you're underweighting, you're underweighting. So you're already underweighting. The key is, if you're overweighting and you say, okay, within stocks, I'm gonna underweight large cap, overweight small cap because it's a strong economy. Here you have a weak economy. You're underweighting. You already know you're underweighting, so you don't have to say even more. And then underweight value stocks as are low quality stocks that underperform growth stocks. recession. Something like that. Doesn't be exactly that wording. All right, so there's 4 right there. A lot of students between this and municipals. There's 7 things right there. That's over a third of the question. And a lot of students will get maybe 1 or 2 points on that. That's deadly. That section right there. So be really, really careful on that. How many things undeveloped? So the first one, underweight. I hate the word weight. Underweight as economies weaker. Yes. What's the second one? What does it say loud? As it's a pretty bad forecast, but some of it's actually pretty correct. The thought that the Fed was going to wait later in the year to cut was good, but the fact that we have a recession, that hasn't happened. Although there are some people who think we went into recession in March, so it's possible. We'll see. Emerging, how many there? Just 1. That one's pretty straightforward. Underweight as their economies will be better. Yes, that one's a real straightforward one. And then alternatives just depends here. There's probably 3 things you can talk about. What about commodities? Underweight. I forget what she said, but we can go back and look. How did she work it? Yeah, expect significant price drops. You can say the exact same thing for real estate, so that one's pretty easy. What else could you say? Well, we could talk about gold. What would you want to do with gold here? Yeah, underweight. Interest rates are rising. The dollar is strong. Inflation's not a problem. Gold is not. And that one was really wrong because gold actually has done pretty well this year. What's the real rate of interest doing? Must be increasing, right? If inflation's falling, interest rates are up. All right, so I got 19. You're going to have somewhere between 17, 18, or 19. All right. Any team want to volunteer to be graded on Thursday? Now? Any takers? Do I have to offer $10,000 again? Y'all want me to put this on Blackboard, on Canvas? I can put it on Blackboard. All right, I'll highlight the parts that aren't part of the question. Any questions on this? The key is that not that you can do this. The key is that you do this without even thinking. It just becomes second nature. That's part of you as a finance major. You hear a scenario and it just becomes obvious what strategy you want, but you got to practice more. That's why we'll do another session or 2. How important is this? Boy, I remember 2008. Boy, talk about stressful times. We were having to decide what to do with our portfolios at UTSA, and boy, it was stressful times. All right. Everybody see what we're going to do on Thursday? So we're putting quite a bit of time into this. So this is a huge investment. No questions other than by grammar.
You said this was a third of our exam grade?
Yeah.
And the question 1 is 2/3.
Right.
Okay.
All right. What's the 10-year treasury doing right now? That's really unusual or really scary. It went above what? For the first time in a few months. back above 4%. Why is the 10-year treasury going up if the Fed's cutting? So that's why it's so important to say what the market expects. Say, well, right, the Fed's cutting rates. Yeah, but if they're cutting rates less than the market thought, the 10-year can actually increase. We've been looking at this, the CME group. I really recommend you put this in your list of things. I really love this website. We've gotten kind of addicted to it. And the compare button, they show you over days, and this includes that employment report. How did the employment report come out? Did y'all watch that? Remember I said you're addicted now the rest of your life watching that? Was it a strong report or a weak report? Strong. How strong? Very strong, somewhat strong. Yeah, it was very, very strong. Unemployment fell 4.1, but that's 200 something thousand jobs was pretty strong. So you can see before that employment report came out, they were expecting there was a 37% chance of them cutting rates 50 basis points in November. Where is that forecast now? Doesn't even exist. It's completely gone. What are they expecting now? Well, when the number came out, they were expecting it jumped from 63% to 84% chance of 25. And then what happened with no cuts? That went up to like 15%. So that jobs report got people thinking, hey, the Fed's maybe cutting 25 and it's a chance they won't cut at all. So that's pretty important. What do we get tomorrow that might influence them, do you think?
CPI.
CPI, yeah, dashboard team. Yeah, they're going to be so ready for their interviews. CPI tomorrow. And what comes out on Thursday? Take a minute to think about it. The FOMC minutes come out tomorrow. So yeah, it's just you get the point where, I mean, the guys I was talking about today, all these Victory Capital people, they want to hire you. I know what it takes to get hired by those guys because I know what they talk about. They talk about it. You just have to realize this as a student, this is all they talk about. And so they're absolutely shocked when you don't know what's going on. Because this is just like, it's like asking someone who's the president of the United States, oh, I don't know. It's like, well, how can you not know that? To them, it's like, how do you not know what the Fed's doing? You're a finance major. So you just got to somehow, that's why the dashboard team meeting, whether you've joined ours or create your own, is so important. You got to find some way that you're looking at this news every single week. So it just becomes second nature. You know exactly what's going on. So what did the Fed do in September? Fed rates how much? 50 basis points. All right, good. Y'all know that's top of your heads, 2 seconds. And if you don't, find out how you can get yourself to be able to do that, huh?
You said the FOMC minutes? What is that? What does that represent?
Well, they had a meeting, and so those minutes come out, right? That comes out on Thursday, doesn't it? Yeah, I'm getting old, so I'll be remembering. You get the FOMC meetings on Wednesday. Oh, I'm sorry, on Wednesday. It's CPI's on Thursday. I got them backwards. Why are those meetings and minutes important? Because they're real picky on how they word the minute. I mean, I can remember when Greenspan, it was a huge deal. Greenspan, you change one little word. I can't think of some examples, but you could just say, it may, and change that to can, or anything, any slight in the word. The market is so parsing. Why did he change? They look at what he said before, what he said this time. Why did they change that one little word? And the whole market's selling off 3% because they changed one little word. So these minutes, they're not quite at that way that was on the Greenspan, because Greenspan was like, didn't tell us anything. And you had to kind of read between the lines. They're a little more clear now, but it's still important. If they say inflation is approaching our target, our inflation has reached our, exactly what it is saying, what's the speed, what kind of adjectives and adverbs they use. So that's why these minutes are so important. It also tells you who agreed and who disagreed and why, what discussions they had. There's one Fed governor who did not like the 50, and she's been speaking. This week, there's a lot of Fed governors speaking. It'd be interesting to see what they're saying, or if they're giving away some of what their hint is, what they think about November. That may be why some of the markets are reacting. If they hear a Fed governor say something where they're thinking maybe more 50 than 25, that would certainly be reflected in how markets react. So yeah, this is your life. So start getting used to reading this stuff. Huh?
So when the Fed is like making public statements, you were saying that the markets are pricing in like every word. Are
On
the,
Greenspan, yeah, definitely.
are the Fed, are they like the speakers, are they very intentional with their word? Or
Some of them are, like there's a Dallas Fed who strongly disagree with the rest of the Fed. And he was going out making really strong statements. That he disagreed, he thought they should change. So you think this person's on the Fed, he's speaking pretty loudly, he may convince the others. Yeah, it depends. Every Fed governor is a little different. With Greenspan, it was more of they'll find out what we're doing once we do it. And he was into, I have a Greenspan quote somewhere I have to show you, which is so convoluted, you're like, what did he just say? But along the lines of, you might think you know what you think you thought I said, but you might be wrong in thinking that you thought I said that, something like that. It's like, what did he just say? He was intentionally vague. But Bernanke was the exact opposite. We're going to be really clear in everything we do. We want the markets to know what we're doing. And not only that, if we can tell the markets are misinterpreting what we're saying, we're going to come out and make a statement. So if they're seeing the interest rates falling, when the Fed's going, they shouldn't be falling. They should be, they'll come out. That wasn't Greenspan though. He was very, very different. All right. Let's continue with this assets execution. There's quite a few topics here to cover. Kind of a hodgepodge here. This is really, you've got your brokered account or whatever you're going to do. And you got to think about how you're going to manage this. If you're going to do security selection, you're going to do it yourself. You're actually going to buy stocks and bonds. You're regulated by the SEC Security Exchange Act of 1933. Why 1933? Well, the Great Depression, stock markets are crashing. There's a lot of regulations coming out during that time. So security election, you're going to hire a broker. I don't know how many of y'all went out and hired a broker since our last class. And you buy stocks and bonds from your broker. I need to do a trade here in class one of these days. I did a trade a couple of days ago, a charity that I help with. We're rolling over treasuries. Brokers trade through organized exchanges, but it's becoming more and more electronic. I was just talking to someone about the investment society saying, hey, let's go to New York and tour the stock exchange, but I'm not sure exactly what you're touring. I'm not really sure what they do in that building anymore. They still ring the bell for some reason. That may be the only time anyone goes into that room. I don't know. Have y'all been down to the Wall Street? Any of y'all got a picture with the bull? Do you get a picture with the bull? Yeah, you have to wait in line, don't you? No, maybe go at 2 a.m. But yeah, sometimes the line's really, really long. I don't know if they still have the little girl in front of the, or they moved, I think they moved the little girl. They used to have the bull and the little girl in front of the bull. So right there in front of Standard & Poor's, and then you got Wall Street. Wall Street's closed down now, the traffic, because of 9/11, but you can get it. There's a great picture if you go down there where you can get the Wall Street street sign, you get the stock exchange right behind it. You can stand there on the Wall Street, you get them both right there together. It's really cool. I took a group from my church down there and we went down there and like, what are we supposed to do? They were like bored. What are we doing down here? So we went and toured a old Catholic church. They were bored to tears. So none of them were investment people. There are some securities that trade over the counter, which means you call up a broker, maybe Bank of America or JP Morgan, and they have an inventory of bonds. And you ask them, what do you got? Or they're calling you, they kind of know your business, and it's over the counter. Over the counter just means two sophisticated buyers and sellers, they trade with each other. Doesn't go through the exchange. It's not quite like the stock market, especially with bonds. Bonds don't really trade every single day. You don't really have a good price for bonds every single day. They trade in very large blocks. In fact, USA was trading in tens of millions of dollar blocks, $50 million blocks. They're just much bigger markets. Corporate bonds and municipals are very illiquid securities, not like treasuries and agencies. They're very, very illiquid. You don't trade them fast because they're trading in $50 million blocks. You've got to find the buyers. It's over the counter. You may call your broker and say, we want to sell 50 million. They got to go find a buyer somewhere, or maybe the broker will take it from you, but you got to will and deal on that. It's a much, much different market. what kind of trades you can do. This is why I do some trades. You can do a market order, which just says, you know what? Just trade the best price you can get me right now. So a market order, you just put it in there as a market order. A limit order is you want to buy a stock at 50 bucks, but it's right now trading at 52. So you don't want to put a market order in because you don't want it at 52. So you put in a limit order and say 50 bucks. If it hits 50 bucks or lower, I want you to buy it. Right? Now, if it closes at 52 today and tomorrow opens at 45, it's going to buy it at 45. It's not going to buy it at 50. So you're not like stuck at buying it at 50. It's not like you say buy it at 50 even if you get it at 42. You're just telling them if it falls to 50 or lower, get me the price you can get me. All right. Otherwise, it'd be really dangerous to put a limit order in overnight. You'd want to wait and see how it actually moves. So that's a limit order. Same thing on the selling. Hey, I want to sell this for 52 bucks. Right now it's trading for 50. So if it hits 52 or higher, sell it. How long does that trade in there? It can be until you cancel it. But even then, brokers might say, well, it's going to cancel automatically after a certain amount of time. Or you say cancel after 10 days or whatever. You can put that in there. The broker will ask you. That's why I need to do some trades. You can see it. It's pretty straightforward. You can do a stop loss. A stop loss might sound like a limit order, but it's very, very different. So a limit order, you're buying something, but you don't like the current price, so you want to put a lower price, or you're selling something, you put a higher price. A stop loss is you buy something, but you're really worried if bad news come out, this stock could really crash. So you say, I'm buying at 670, but if it falls to 640, I want you to sell it. Because I know I made a mistake, the stock's going under. That way, if you're out, in Cancun or something, and you bought this stock for 670, and you don't have time to look at the market, say, at least hey, if it's 640, I'm out there, I'm done. You got to be very careful then. What if it closes at 670 and opens at 600 the next day? Then you're in a lot of trouble because you're not going to get it at 670. You can't get 670. It never did that. That's what we call discontinuous prices. Prices don't always move on a line. They can close at one price, open at another. So you always have to be careful about the closing price versus the next day. It's rare for stocks to just drop all of a sudden, although they can with earnings announcements. So that's the stop loss order. That's somewhat of a risk management tool. If you do it yourself, you're competing against, from MIT, you may not be competing against finance major. You may be competing against math majors, PhDs in math. So you're competing against some pretty, like James Simons, probably the most famous investor out there. He didn't have a finance degree. He was a mathematician. So you're competing against some pretty impressive people. They're spending 40 to 50 hours a week on this. So you may be spending 3 or 4 hours a week on this. And they're only following, and on the sell side, they're only following maybe 10 or 15 stocks. You got to look at all 60,000 stocks. So it's challenging. It's really challenging to compete. On the buy side, they may be covering a lot more stocks, maybe 50 or so, but they've been doing this for 20, 30 years, and they know them backwards and forwards as it is. I used to talk to people on the sell side. There, they cover so few stocks that there wasn't a question you could ask them they didn't know. You ask, hey, when's their third grandson's birthday? And they would know it. They know everything about the stock. They know everything about management. It's incredible, the knowledge they have. I just sat there just going, this is amazing. But that's all they do. They cover these few stocks. They don't have a lot. They cover those few stocks and they learn them just backwards and forwards. So I went on vacation in Europe, my first time to Europe, and I had a friend of mine who was already over there. So we went over and visited to meet up with him. And then he had other friends joining that I'd never met before. And one of his friends was a pilot. And he found out I was an investment person. He goes, oh, Ron, I got the best broker ever. And I then asked the question that ruined the rest of his vacation. I asked him, how do you know? Seems like a simple question, right? If you say, I have the best surgeon ever, how would you know that? Well, he hasn't killed anybody last year. Well, yeah, there's 1,000 other surgeons. Do you really know your surgeon's the best surgeon? Do you have any data to prove that? Do you know your broker's the best broker? He says, well, I think he is. He's sending me trades all the time. I said, yeah, but how does he make money? Oh, every time I trade. It sounds like he's making money, but are you making money? And how would you know? So I just ruined his whole trip. It's like, yeah, I don't know if my broker is any good or not. So I don't know if he is or not. Probably not. Most are not. They're really good at getting you to trade, but are they good at getting you to beat the market? So the question I said is, are the trades you're doing performing better than if you just bought the S&P 500 index. And he didn't know that. Why? Because most Americans have no clue what their stock portfolio is doing. In fact, there was a study done in the 90s when stocks did nothing but go up. They asked Americans how they were doing, and most said they're doing great, and the majority were losing money. Pretty incredible. In a market that was doing nothing but going up, the majority of Americans are losing money and thinking they're making money. So there's a good chance his broker wasn't doing well. For him, he's doing well for himself, but probably not for this. So how do you know a broker's doing well? Well, today you don't care because most of you are hiring discount brokers who don't do anything but give you a trading platform. They're not coming to you with trades. Those full service brokers is kind of a thing of the past. So I don't know. I haven't seen him since. He's avoiding me. So, all right. So let's say you don't want to do it yourself. You're going to hire someone else. Here you're regulated by the SEC Act of 1940. And there's several things you can do here, but mutual funds are the most common one you're going to look at. We're going to talk about exchange traded funds. Exchange traded funds actually fall under security selection. You buy those through a broker, and that they're a little different thing. But here, mutual funds, you're hiring a manager. So mutual funds, these are investment companies. They create a commingled portfolio. They just put a bunch of people's money together. And they manage it and charge a fee. BlackRock is the largest. How can we figure out what number, what word would you use for BlackRock? How would you figure out the size of BlackRock? So AUM, what is AUM? Ask another manager. Is it over 10 billion yet? 10 trillion, excuse me? Around, is that more or less? Around. So BlackRock, if you study BlackRock as an investment, it's a very high beta, very cyclical firm. Why? Because they make money by charging a fee over assets. What happens to their revenue when the stock market falls 20%? If you're charging 1% times your portfolio and your portfolio falls 20%, guess what happens to your revenue? Your revenues fall 20%. Very cyclical firm. BlackRock is predominantly index funds and bond funds. So when bond markets fall, BlackRock tends to see their revenues fall. But very cyclical, very, very cyclical firm. But around 10 trillion. How big is Vanguard now? You're getting close, aren't they? Statista, would they tell us? No. 8.6 trillion. So they're getting up there. They're a pretty good size. Fidelity. I wish they would just tell us, but they don't. I don't see it anywhere. So 5.3 trillion. Now they have 13 trillion under administration. I don't have that for BlackRock. What does under administration means? That's when it's a very different. It's kind of funds that they're holding for other people, but they're not really responsible. I mean, it's these firms have so. Fidelity is a record keeper, so they can be the record keeper for 401k plans that they're not managing the money. So it's under their administration. They're doing all the trades and all the dividends and all that, but they're not actually managing the assets. So they have 13.7 trillion. Most of that's probably 401k plans. They're not managing any money, but they're the record keepers. You're just holding on to the money. I don't know if those are the three largest, but those are three of the largest. BlackRock is certainly the largest. I'm pretty sure Vanguard is the second.
What about Capital Group?
Capital Group's pretty up there. It's very, especially with American funds. Is one of the largest. Y'all see it yet? Of 2.5 trillion. They're up there. They're hiring. We're going to talk to them on the 23rd. So if you join the Investment Society, come hear them. They're trying to hire UTSA students. Good firm. We don't tell them when they're here, but USAA, we tried to hire American funds because we really liked them, but their management fees were too high. So they're good, and then they're good, so they charge a lot. And we just like, yeah, we're not paying that. But they are a good fund, a good firm, very highly respected. They have some really, really famous funds in their mix. All right, so when you have a mutual fund, you have something called a NAV, which is the net asset value. It's struck, we say struck, it's struck once a day at the end of the day. What they do is look at all the investments, they look at all the liabilities, and they figure out based on the number of shares, and you have fractional shares, what each share is worth. And that's struck every day, and it's printed every day, usually around 5:30 p.m. When I was at USAA early in my career, one of the women I worked with, she was on maternity leave, and she said, I need someone to strike my nabs while I'm gone. And so I said, okay, I'll come do their net asset values while you're gone. You always volunteer. When people say, I need someone to volunteer, you raise your hand before they finish. All right. So she said, I need someone to strike my net asset values every day. I said, I'll do it. I'll volunteer. So I got to see that process while she was on maternity leave. It was pretty interesting how to do it every single day. I had to sometimes go out like 20 decimal places to get it to work. And it was just amazing. But it's interesting. It's not that difficult to do, but you got to do it fast. Now, when I was the portfolio manager for mutual funds, I would look at my NAVs every single day. And there's one day, one of my funds was struck. And I called accounting and I said, there's no way that number is correct, because it did not make any sense. And they all checked, and there was an error. And they had to call all the accountants back. They all went home. They had to call them back. Do you think they were mad at me or happy with me? What do you think? Honestly, they were on their way home. Sounds like mad, but what were they really? They were happy. Why were they happy? If that error had continued to the next day, guess what? Of a mess it would have created. If they sent people money based on the wrong NAV and bought people's shares on the wrong NAV, what do you do with someone? You send them $3,000 and say, oh, wait, we struck the wrong number. You need to give us $200 back. Do you think anybody wants to make that phone call? So they were happy that I called. So I would check every day. I said, y'all did something, someone transposed a number or something, but there's no way that's the NAV from my fund. So there are errors occasionally, not very often, but if you have an error, it is an absolute mess. Probably what they do, and I don't know what happened that day, they probably have two people calculate it to compare to make sure it's exactly right, because it is a disaster if it's wrong. It's struck every day, and that's the key with mutual funds. You can only buy them at end of day, NAV. You can't buy them intraday. And so, but you do get fractional shares. So if you say, I want $5,000 of the Magellan Fund, you'll get $5,000, and they'll figure out how many shares that is. That may be 50.2.7367, whatever. You'll get fractional share. That's kind of the nice thing. You can't do that with stocks. With stocks, you got to buy, 10 shares or whatever. So you can do fractional shares. For mutual funds, you just say how much you want to buy. You don't say how many shares you want. You can also sell at the end of the day NAV, but you don't know what that is. You have to put your sell order in before you know what price you're getting. So, but as long as you put it in before the market closes, they'll honor that trade. What this allows you as a small investor, some of these Vanguard funds have hundreds of billions of dollars in them, maybe even trillions. They're massive, massive funds. If you're investing $2,000, you get to become an investor in this massive fund, and your fees are really, really, really low. So it's a really, really good way to become an investor without it, having to buy individual shares. All right, but what's popular today? Not mutual funds. What's popular today? Exchange traded funds. So we'll talk about them next class. Questions, anything? What we're doing on Thursday? It looks like I saw some of y'all preparing for today, so that's good. Prepare even more for Thursday. Some of y'all are kind of just sitting there looking on Thursday, be a participant and contribute in. All right, I'll see y'all. And we're practicing, what are you looking for? Anytime someone gives you a forecast, there's key things that you're looking for. The most obvious one, y'all didn't give it to me on Tuesday. What's the first most important thing you're looking for? Economy, recession. So what are they saying here? Recession, all right. What's the second thing most investors are interested in? All right, inflation. What do we say here? Falling. Even before inflation, though, what's everybody's focus on in November? Yeah, interest rates. And what two things on interest rates? Whether they're rising or falling, what are they doing here? Falling. And what's the other thing? Are they more volatile or less volatile? All right, and you get inflation falling. What else might we look at? Spreads. What word do they use here? Gap out. Why gap out? Because widening could be 1 basis points or 100 gaps. And to me, says it's going to be a little bit, a large change, not going to be 1 or 2 basis points, maybe 50 or 100, depending on which class. What else? US dollar is going to do what? Gonna weaken. What about, well, what do you have left? So international. So you got 2 things there. What did they say there? Developing is emerging, right? Developed. We'll do okay and emerging. All right. You know, these forecasts, they look pretty bad, but there's always something pretty good in there. It looks like they got China pretty good on that one. Anything else? What about alternatives? Real estate, okay, with falling rates. Commodities, weak, and then one other one you probably get out of this one. What's really going to do well in this environment? Gold, probably. But what? So gold loves weak dollar, low interest rates, and inflation, but it's hard to get all 3 of those at the same time. Because if you have inflation, rates are going to rise. The dollar tends to do well if interest rates are rising, unless there's inflation. You know, there's a hodgepodge. So you're trying to get a sense of it. Gold might do well in this environment. If you look historically, gold has been more of a protection against the dollar than it has been against inflation. Commodities are probably weak because inflation's coming down. So that's, you know, gold tends to be its own independent thing. So I think we've got most of the things there. So let's look at what they said. I don't recommend doing it the way they did it here, but we can work with it. I prefer you do it on a separate piece of paper just so you make sure you get them all down. But so long-term treasuries, overweight, expected recession, expect rates to fall. I give them 2 on that one. Short-term inflation index funds, underweight, inflation is falling. Give them 1 on that one. Mortgage-backed securities, underweight, we want to buy convexity and volatile interest rates. It's not worded great, but they were in a rush. So I'll give them 4 on that. But if interest rates are going to be stable, you would say buy mortgage-backed securities, sell convexity, but always put on that last part because you want to pick up that extra yield. That's always an important component there. All right, we got high quality on the bonds. So they said overweight, high quality, won't. They probably meant in recession. Overweight, interest rates are falling. They didn't tell me what they wanted to overweight on. What were they looking for there? So they got the high quality. What did they forget to mention? They forgot to use the word long-term, but I knew what they're talking about, so I'll give them half credit for that. And then what was the tax-adjusted yield here? 5%, 370. It made it easy for y'all. So overweight corporate, underweight muni, and they gave the number. If they had a little more, they could put it out there, but I'll give them 6.5, so 2.5 on that. They're getting it all. You can do it like this. It's just it's kind of hard. Underweight, I agree with that. So they got that. On high yield, you definitely don't want high yield. Anything that says recession. Now, one thing we're not talking about. So if I gave this to Victory Capital, the one thing they'd be looking at that you're not looking at, they'd be looking at those yields. And that's because we don't have enough information. They'd be looking at the yield and high yield and say high yield 820 versus treasuries at 480. That's 340 basis points. That's not all that great of a spread. And we're expecting a recession. Yeah, I don't know if high yield makes sense. But that's the one component we're missing. Remember GMO, they're talking about how they like value stocks, even if interest rates were to fall and even if we have a recession. Why? Because they say they're so cheap. So that's the part we're ignoring. These yields might be good enough to still go against convention because they're so high. So we're somewhat ignoring that. But high yield yields, that's not a great yield for high yield if the 10-year is at 480. Okay, do they have stocks versus derivatives? Stocks versus bonds, overweight bonds over stocks on high quality. They forgot to put recession, but I'll give it to them, but on the exam, they want to make sure they get that. All right, now let's look at stocks. Large cap growth, overweight, large cap, better than small cap. Growth rather than value. Again, they forgot to put because of the recession. Don't forget that. All right. I'll give them half on that one. You got to say why. You say large cap do better than small cap. I mean, you say that in an interview. It's like, what are you doing right now? Oh, large cap are better than small cap. Are you saying that because that's always true, or because you're expecting something? Saying you're expecting recession is the important component there. On the way, small cap fares worse. They're kind of implying a recession here. High beta creates more risk. So I'll give them one there just so I scare them for the exam to remember to put that recession in there. So they got 2 out of 4 on that one. Developed, overweight, stronger economies than US. Why did they forget there? No, they got the economies.
US dollar.
US dollar. They missed one on that one. Yeah, make sure you get the dollar in there. Emerging, underweight, weaker economies, expected recession. So that one's kind of the gimme. Alternatives, gold and silver. Overweight due to weak prices. That one's a little bit hard to read. US dollar. I'm not going to give you that one, but I see where you're going. Real estate, it does just run out of time. That's probably part of it, right? You need more time when you're doing it as a group. When you're doing by yourself, you can probably get more in there. Overweight due to lower mortgage rates. I'll give them that one. Underweight falling. So I'll give them 2 on that one. That's 14.5. Plus 14.5 divided by, if we do the full 18, that'd be 81%. Sometimes I divide by 17. So they're at 85 with a couple weeks still to go. So they're in pretty good shape. And probably they'll do better if it's not a team exercise than if it is a team exercise because they have a little bit more time. But you see how it's better to write it out on a blank piece of paper just so you can kind of spread out. It's a little squished in there. Any other comments or questions? They did write out the environment just like we did here. I like doing that not just to prepare for the exam. Now that may be why they ran out of time. It does slow you down, so you have to kind of think if you want to do that. I want you thinking that way because when you think of scenario, what are those things? So if someone says, hey, how would you invest next year? Your boss says that, well, all right, well, what do we think about you before you even answer the question? What do we think the economy is going to do? What are interest rates doing? You want to go through that list and think through those scenarios.
So if the economy is coming out of a recession, would you say value over growth or growth over value?
Coming out of recession, I would do value. Yeah. So that's part. I hear people, in the discussions, I hear, well, do we want high yields or high spreads or low spreads? That's not really. We're more interested in where we're moving to. So you can say, hey, we're in recession. Oh, we should be buying a large cap, not small cap. Well, no, if you're in a recession, the question is, where are you in the recession? If you're coming out, you want to buy the risky stuff now. So the question isn't where are you? The question is where are you going? So if your boss says, hey, I think we're in a recession, you don't say, well, let's be conservative. Your question is, so where in the recession are we? Because if you're in a recession, the market's already reacted. So the question is, how far along are you? If you're in 2008 and you're sitting there in September, you still got 3 more horrible, well, really 5 more horrible months to go. You got a little bit of rally in December. Yeah, so it kind of depends. So the question is, where are you going? Are rates rising or falling? Not are they high or they're low? That's not the question. The question, are they rising or are they falling? All right.
Where do we talk about the spread scapping?
Well, that's really where you got the high yield, high quality right there. Right? Because if you have high quality bonds, they're not going to gap as much as triple B bonds. High quality bonds go like from 10 basis points to 15 basis points. Triple B go like from 150 to 220. So you're going to lose a lot more money on the triple B.
Value versus growth.
All right, so the key on value, there's a couple things, but the real key is that value, don't confuse value with quality. Value is low quality. If you remember that, think of value as kind of like high yield. Value is low quality. They love strong economies. They go out of business. If you think about the value stocks, you know, it's Bed Bath and Beyond, it's Macy's. It's every stock that you can think of that you don't go to anymore. You don't shop at it anymore. They're just weak. So a recession is going to crush them. We also talk about interest rates. Since value stocks, they're not going to live much longer, not fast growing. Most of their value is pretty short term. So they're not as sensitive to interest rates. Growth stocks, so much of their value is way out into the future. So they tend to be longer duration. They tend to be more like, so think of value stocks as low quality and short duration. Growth stocks is high quality and long duration. If you can kind of think of it almost in bond terms, it can help. I don't like the word value because people think value and think quality. This is a really good value, but that's not what a value stock is. It's a stock that's really struggling. All right, good job, Team 5. That's a good.
I do have one question for the municipal and corporate. To get that full third point, you do want us to include the actual tax yield from the calculation. Correct?
Yeah, give me the 5%. I think y'all did that.
Yeah.
Yeah, give that calculation. Where I see students really mess up is they'll calculate it for this, and then they'll calculate it, they'll take 5.1% and divide by 1 minus the tax rate. That's a completely meaningless number.
Yeah.
Now, if you have a Roth IRA, how much municipal bonds are you going to put in your Roth IRA? What's a Roth IRA? What's the tax rate on Roth IRA? It's 0. So when you do the tax adjusted yield, what's the tax adjusted yield of the muni in a Roth IRA? It's 375. It's the same because there's no tax rate. So you don't put taxable bond, you don't take. So at USA, we had a tax-free organization called the reciprocal. We had taxable organizations. We never put municipals in the reciprocal because it was already tax-free. We only put them in the taxable companies. I hope you're getting better. We'll see, Chris.
So when things are gapping, could you explain, short-term, intermediate, and long-term, like what would be most preferred?
Well, we haven't talked about, there is something called the term structure of credit spreads. I think we talked a little bit about that. We'll talk about that more when we talk about bonds. So when spreads widen, they tend to widen much more for longer term than for shorter term because the risk is greater. I didn't mention that here, but that's kind of just known. So if you expect a recession, you want high quality, you might be really longer term on the treasuries, but if you have triple Bs, you probably get hurt much more on the triple Bs at 10 years than you will at 2 years. So that's why I say with high yield, just ignore interest rates rising or falling because all they care about is spread. So high yield can get really crushed in a recession. So there's a lot more complexity of those things. I mean, you got to think through all the different pieces. I wish I could show you Western Asset. Western Asset goes through all of these and they set their strategy up. They talk about the direction of rates, the volatility rates, what are spreads doing, and they set up their strategy. It's the way, this is the way finance thinks. I'm trying to find a problem where your mind just automatically starts going through those steps. So if you get an interview, in fact, if I were you, an interview, you'd be much more impressive if they say, hey, what would you be doing for your investment strategy right now? Instead of saying, oh, I like stocks right now, I don't like bonds. You might throw it back at them. It says, well, it depends on the scenario. If you want to throw out a scenario, right, are you expecting a recession? Are you expecting rates to rise? Are you expecting rates to be volatile? They're going to be much more impressed with that. They might say, well, no, what do you think? Well, I think we're going to have a soft landing. The Fed looks like they're doing all right. Inflation's coming down, not really fast, but I think it's going to be under control. But I doubt the Fed's going to cut as fast as they thought. So I think interest rates and, they're going to be really impressed if you can do that. Hopefully this exercise is starting to get you to think like that. Let's say you get an interview right after the exam or right after one of these team cases and they ask you that question, just cheat and use the case you just saw. All right. It doesn't, right now, what you believe right now, it's like my composition professor. Just do something now. You're going to hate what you do today, 5 years from now anyway. Just pick something, go with it. So you're practicing the application. You're not trying to set your opinions for the rest of your life. You're trying to practice the application. So just go out there and say something that might be really stupid 5 years from now, but it doesn't matter. They want to know that your mind is thinking like a finance professional. So just throw something out there. Just use this scenario right here and just go with it. It might not be a great scenario, but that's not what they're looking for. They're looking, do you understand finance? Can you speak the lingo? Can you understand, how these things work together? You know, you're not going to say, well, interest rates are inflation is really going to rise and interest rates are going to really fall. Doesn't make a lot of sense. So you just kind of get how these things move together. All right. I'll try to put that out there. So 14.5 out there. Y'all have to take notes what they got credit for and didn't get credit for. Hopefully y'all got all that. It's not going to be in here. I will put this out there though. If I can find it. Oh, there it was. All right. So the bigger question might be, to see if you're wasting your time, is what you did today any different than what you would have done if I handed this to you 3 months ago? So that's the question. Any different today than you were 3 months ago? Or are you exactly the same today? So you're wasting your time. If you're exactly the same today because you don't understand any of it, that's bad. If you're exactly the same day because you already know it, you took a class you probably shouldn't have taken. But if you think differently, then the key is retention. That's why you're here, is retention. It's not to get grades. It's that this sinks in, you understand it 5 years from now. You need to practice it, go over and over and over again. I can't give you too many more examples, but you've got several to work with now. The key is to know the template and be able to work through it. Okay, let's keep working through. So last class, we talked about mutual funds. We're talking about execution. Mutual funds are not as popular as they used to be, mainly because exchange traded funds have really taken over. But all of these mutual funds, exchange traded funds, they're in a broader category of commingled accounts. It's when a bunch of investors get together and they all invest together. Commingled accounts can be all different types, but one that there is called a separate account. Our commingled account can be a separate account, but a commingled account is when large investors get together and they invest with a firm like Barclays or Vanguard. There may be 20 really large investors, but no retail investors in that account. They get really good fees, really cheap fees. They may show up with 500 million bucks or something, and they get into that account. Why do they like that? Instead of a mutual fund, they get lower fees. Plus, they don't have to worry about the retail investor doing a bunch of trades that's messing up their portfolio, creating realized gains and losses at the wrong time. So it's large institutional investors. An exchange traded fund, mutual funds, they're also somewhat commingled accounts, but exchange traded funds, they're like mutual funds, except for they're mutual funds that have a stock ticker and they trade just like stocks. So it's like buying a mutual fund, but remember, mutual funds, you can only buy at the end of the day. You can only sell at the end of the day. Exchange traded funds, you can sell as long as the market's open. I like them a lot better. I don't use mutual funds at all anymore, except from the bond side. For buying bonds, I tend to like mutual funds because I don't trade my bonds as fast as I do stock. But exchange traded funds, they're very, very liquid. They're very easy to trade. Very interesting securities. And then you're going to get, well, exchange traded funds, supposedly you can get better control over your taxes. I used to not believe that, but then I read an article and I can't remember the details of it, but that article convinced me that, yeah, exchange traded funds do have some heavy tax advantages. They're probably not a bad vehicle for you to get into when you first start investing. Because if you have $500 to invest, you're gonna have a tough time buying individual stocks. You know, at 500 bucks, you can only buy like one share or 4 or 5 stocks. But with a mutual fund or ETF, and the mutual funds, a lot of times they have a minimum of 2,000 bucks, $3,000. So you can't even buy a mutual fund. Now there is a difference. Some mutual funds, if you set it up as a Roth IRA or traditional IRA, they'll let you invest as little as $25 or $50 a month, as long as you do direct deposit. So they'll let you do smaller amounts, but it's really hard if you only have a few $100s. But if you have a brokerage account and a few $100s, you can buy exchange traded funds, which means with just 50 bucks, you can be extremely well diversified. You can buy an exchange traded fund that buys every stock in the United States. And with your 50 bucks, you now have every stock in the United States. So it's a way to get really, really diversified with very little money. But most of you are going to do this, your 401k plan. And essentially, it is a commingled account. Some 401k plans actually use mutual funds that you can see the actual mutual fund. But that's a 401k plan. Your employer will offer it, and most of them are gonna look just like this class. They're gonna have bonds, they may have long-term, short-term, intermediate-term bonds, they're gonna have stocks, they'll probably have large cap, small cap, developed markets, emerging markets. They may have growth. I think I told you at USA, we went from 3 to 13. I added growth, I added value, added large cap, small cap. Just to give them all these asset classes. We didn't do developed and emerging, we did an international because we were worried about emerging. One thing we noticed with USA employees, it was kind of scary. They used to mail out a statement every quarter, and I would look at that statement, and whichever of those 13 options had the highest return, I would have to call that manager and tell them, you're gonna get like 200 million bucks tomorrow. Because I knew employees are gonna look at the statement, and whatever had the highest return, they're gonna move all their money to that. Not a smart investment strategy, but that's what a lot of them did. And it's so predictable. It's like, you're gonna get some money tomorrow, just be ready.
What do you think about 60/40s?
What?
60/40s,
60/40, like 60
Like,
stock, 40 bonds?
yeah.
For you, I would do 100% stocks. It depends on your age, but.
But in terms of like investing based off of like this, the case, like how would you position everything?
Yeah, if I were your age, I would, well, 3 years ago, I would absolutely do 100% stocks. There's no reason to buy bonds when the 10-year is at 0.5%. So I disagree with Vanguard and Fidelity. They put you people your age 90% stocks, 10% bonds. To me, that's ridiculous. First of all, you don't have 90% stocks and 10% bonds. You do in dollars, but you don't in risk. In risk, you're like 97% stocks, 3% bonds. So let me assure you, you put 90% stocks, 10% bonds, and you do that so you have some risk reduction, you're not going to notice it. That 10%, you're not going to notice it. In 2008, I did not hear anybody in 2008 saying, boy, I'm sure glad I had 10% in bonds. I lost 33%. I could have lost 34% if I didn't have those bonds. No one was talking like that. You didn't even notice it. When the market's up, you notice the bonds because it's dragging you down. When the market's down, you don't notice. You don't know. Y'all think you're gonna notice between a 33% loss and a 34% loss? You just lost a third of your money. That's all you care about. So when you're young, just stick your money in the stock market, and then you get in your 30s and 40s, you now have 100,000, 200,000 saved up, 500,000. Then you start moving in the bonds to start leveling some of that out. But when you're starting out, you're just going to the stocks and you hope the market crashes. You're buying cheaper. You're not going to notice the volatility market right now, 50 years from now. It's just going to be just really, really inconsequential noise. So yeah, I'm more just go 100% stocks. Actually, if I were you, I would probably go 80%, 90% stocks, and then I hold the other 10, 20% out for individual stocks that I just want to bet the farm on. Some battery development companies, some EV company in China, some AI company that's up and coming. That looks interesting. They're doing something, listening to business breakdown, hearing some new firm. I'd just be looking around. I'll probably go to Kathy Wood's site. What is she buying right now? She got Pure Storage, whatever that is. Shopify, that makes sense. That makes sense for her. So you're looking for some small company, maybe a $100 million, $200 million company, and they're doing something really exciting. So that's that. I'm gonna do that with 10, 20% of my portfolio. I might start moving into some company, maybe slowly. I'm not gonna try to find them all at once. I might be looking at what she's doing because she's trying to get those up and coming firms that are gonna take over. With the philosophy of you buy 20 stocks and 19 of them go insolvent. So you lose 100% on 19 of them. Well, one of them's the next Microsoft, you'll make a fortune. So you don't have to be right 20 out of 20 times. You just have to be one of those be the next Microsoft and you'll make a fortune. So that'd be my mentality. So one of these EV companies is going to win. Maybe it's Tesla. They're kind of expensive or very expensive. But maybe the EV companies are too expensive. So maybe I'll find one of those battery development companies that maybe their idea is going to take off. There's a lot going on with microbes and health and human health. There's some companies doing that. Boy, they're doing horribly. But boy, if they find the next cure for whatever, and they're doing some amazing things, it sounds really grotesque, but their customers are like, I don't care what you can do to my body. If I can get over this disease, I'll do it. Those are billion-dollar firms if it works. If you're wrong, then you lost 1%, but you only have 500 to invest anyway. What's the big deal? So When you get your 401k, you're gonna do exactly what we're doing in this class. You're gonna try to figure out where we can put each of those pieces.
So what do you think about putting money into penny stock?
And what?
Into penny stocks?
Yeah, I wouldn't buy penny stocks ever. They're essentially bankrupt companies. And their stocks are only trading because they just haven't shut them down yet. There's probably some penny stocks somewhere in the history world that went from 2 cents to $20, one out of 50,000 of them. But like General Motors was a penny stock before it went insolvent. And then it went insolvent. I know it's a stock now, but those stockholders lost all their money. So yeah, I wouldn't touch them. You'd have to have some saving grace. I mean, Sears, Roebuck, a company you've probably never been to their store before. You know, these are just companies going out of business. 401ks, your employer often matches you. USA matches up to like 8%. So you want to go into your 401k and match up. If you do that, you are kicked out of the Roth IRA and the traditional IRA. So the IRS is not going to let you do 401k and an IRA. You have to pick, but you're going to do that 401k because your company is going to match. And you want to do that 100%. If you need the money, that's fine. You can always get your own money out, but at least go in and match it up. And if you get desperate, you can borrow your money back, but at least get that match. Because if you don't get the match, you're throwing that away. So get that. The only thing you have to worry about is the vesting. So your money is your money. You never lose that. But the company's money may vest over 5 years. So if you don't work there for 5 years, you may not get what they match. But if you think you're going to be there 5 years, or even if you don't, just go ahead and do the full match. So get that in, whatever that max is, whatever the amount that they match up to, do that. One thing to be careful of, this is the thing I battled at USAA, is bundling. I battled it twice. I hate bundling. I think it's a ripoff. So what bundling is you go to Fidelity. So USA, when you do a 401k plan, USA, you have investment management companies, you have record keepers, and you have your actuarial firm. The record keeper is doing all that information for your employees. So your employees know how many shares they have, what their account is worth, all of that. They do that. That's the record keeper. Then you have the investors. Those are the people you give money to invest. The record keeper keeps track with the investors, make sure all the money's in the right place. Well, Fidelity comes to you and says, you know, it's like at USAA, we paid like $500,000 for record keeping. But Fidelity comes to us and says, hey, USAA, we'll give you record keeping for free if you make us your investor. That sounds pretty good for USAA, doesn't it? USAA gets free record keeping. We save $500,000 just like that. Why does Fidelity want to do that? So they can grossly overcharge your employees for investment management. And I've seen it. Fidelity, they charge 0.4% for this fund, but if you let them be your record keeper investor, they'll charge 0.8%. Essentially, who's paying for that? Paying that $500,000? Your employees are. And how much are they paying? They're probably paying $1 million to cover that $500,000. Fidelity, why does Fidelity want to do that? Why would they give up $500,000? Because they're going to make an extra $1 million off the employees. Does that sound fair? Sounds great for the employer. How does it sound for the employee? It's a huge ripoff, major ripoff. Should be illegal. It's not illegal. It should be illegal. Why should it be illegal? Because when I was working on USA 401k plan, I was a fiduciary. A fiduciary can make decisions only in the best interest of the plan participants. Does it sound like USA saving $500,000 by shifting $1 million to employees? Does that sound like in the best interest of the employees? It sounds like in the best interest of USAA. I fought that hard twice. Finally, the head of HR, she was so mad at me. She said, I'm going to show you, Ryan. I'll bring it up the next committee and we're going to vote on it. And once they vote on it, you're done. And so I was ready to go follow my sword. She brings it up. And before I follow my sword, the president of the investment company goes, why would we ever want to do that? And I was like, I didn't have to worry about it, but I was pretty irate about the whole thing. So be careful of that. How do you know if your firm's bundling? You know, ask me. I can tell pretty quickly if they're doing that. A lot of small firms have no choice. That's the only way they can get it to set up. But you can tell it's pretty obvious. Let's look at what fees you're paying as an employee, what your management fees are. If they're 1% fees or in that area, you're overpaying dramatically. At USAA, we had 401k plans that were paying one basis point, 0.0001. So if you're a large employer like USAA, you should pay almost nothing in management fees. You should pass all that savings on to your employees. And USAA wanted a bundle and then pass a lot of fees on the employees. It's a ripoff, should be illegal. ERISA, who manages this at the federal government level, they thought about making bundling illegal. But the investment world was so irate, they went and fought it, got their lobbyists, and they didn't get it passed. But it's a horrible practice, shouldn't be done. All right, so those are your choices. If you're going to do it yourself, set up a broker, you can buy stocks. If you're going to hire a manager, you may still need a broker. Brokers, you can buy mutual funds, exchange traded funds, you can buy these type of things through your broker. Your 401k plan, your employer will provide that, and we'll have it just in the same type of asset classes we're talking about. Everything we talked about in this class is going to help you through that. In fact, I think it'd be fun to join some of you on your employee orientation, where the person comes in to explain the 401k plan, and after taking this class, you can ask some really, really pointed questions and maybe scare the guy to death he's presenting to you. Say, why don't y'all have a value and growth fund? Or why don't you have a small cap value? You have a growth fund, you have a small cap fund. Why can't we have small cap value? The person presenting is not going to be able to answer those questions, but it'd be kind of fun, to show off that you've taken this class. All right, let's talk a little bit about when we talk about indexing. What are the indexes? Where could you invest? So on Bloomberg, where would you go on Bloomberg to look up all the markets in the world? Morley, Tristan, what function? Sandy, what's function in Bloomberg? You type in 3 letters. WEI, World Economic Indicators. You go in there, every single stock index, not just China, but all the Chinas, all the European, all the UK. There's multiple. I think China has 6 or 7 of them. Japan has several of them. So all those indices. Why there's so many of them? Because there's large cap, there's small cap, there's tech sectors, there's value growth. That's why there's so many indices around the world. But the most important ones are on this page, the ones you hear the most. S&P 500 is by far the most important one. Standard & Poor's 500. 500 are the largest stocks, not 500, not these 500 largest. There's a few large ones that aren't in there, because Standard & Poor's does try to get the mix in industry. Some people don't think this is a passive index. They think it's really, S&P is actually managing it. They're not managing it to try to make money, but they are managing it to make it well represent the U.S. economy. I've always confused on Berkshire Hathaway whether they're going to put that in there or not. It's a little bit confusing as a stock. So there are some large stocks that haven't been in there just because they're so unusual. But the S&P 500, it's a market-weighted index, which means the weight to Apple is the size of Apple as a stock. So if Apple's the largest stock in the U.S. economy, it's going to be the largest stock in this benchmark. If Apple goes up 1%, the weight on Apple is going to go up 1%. I mean, it's the market weights are going to go right with the market. And the nice thing about that is you don't have to trade very often, because if the market goes up, all your weights adjust automatically, which makes the S&P a very growthy index, because growth stocks are expensive, value stocks are cheap. So the S&P is going to be growthy, more growthy than value-y, because growth stocks are going to start dominating over time. The Dow Jones, I don't know why that's still reported. You're not going to hear the Dow Jones much, mainly because it's a price-weighted index, which is so bizarre. And it's price-weighted, but it's adjusted for splits and other things. So over time, I mean, a stock's trading for $50 and another stock's trading for $100. They're going to put 5 times more in $500 stock, or 500 versus 100. $500 stock, they put 5 times more into it. And then the $500 stock does a 5-for-1 split. It's now $100. They keep 5 times more in that stock because they have to adjust for the split. I don't know how they keep track of that over time. It's just ridiculous. It makes no sense to me. But anyway, the Dow is out there. One reason we like the Dow is it's been there a very, very long time. It's got a lot of history, so that's kind of interesting. Small cap, for some reason, Frank Russell has been the dominant in the small cap. The Russell 2000 has always been our thought go-to for the small cap. S&P does have the S&P 600, which is a small cap, but Russell's been the champion there. Mid cap, S&P has been that. Really, Russell is a little bizarre. Russell has the Russell 1000, which is their large cap, like the S&P 500. They have the 2000, which is small cap. So they kind of blocked themselves out of a mid cap because they have the 1,000 and 2,000 and the 3,000 is the whole stock market. So S&P has the 500, the 400 and the 600. So large cap, mid cap, small cap, and then they have the S&P 1500, which represents the whole market. But those are the most popular ones. MSCI used to be Morgan Stanley, but it's no longer Morgan Stanley. They spun them off, so MSCI is MSCI. I don't think the MSCI stands for anything, but it was a subsidiary of Morgan Stanley Capital Indices. They then sold it off, and I think they changed the name to MSCI. So you might even see the article, MSCI changes its name to MSCI. USA had an article like that. USA changes its name to USAA, but what they're saying is United Services Automobile Association is now officially just USAA. Morgan Stanley Capital Indices is no longer that, it's just MSCI. So it's just 4 letters that don't mean anything. But they have the developed markets. The most famous one is EFA. And then they have an emerging market one, but so does Standard & Poor's. Standard & Poor's has a developed market. They have an emerging market. So all these companies, they compete with each other. On the bond market, oh man, it keeps changing. So it used to be Lehman Ag. Why don't we call it the Lehman Ag anymore? Because Lehman went out of business. We used to call it the Merrill Lynch Ag. The Merrill Lynch went out of business, got bought out. So now it's the Barclays because Barclays bought Lehman. But I don't know anyone who calls it the Barclays Ag. So we've lost our ags, but these are the bond aggregates. But it used to be Lehman and Merrill. Those are the 2 big players. Lehman used to dominate the bond market. When they went under, the bond market was thinking, what are we going to do? Because that's where all our traders are. That's where all our analysts are. But Barclays bought that up for a really cheap price. Some people are pretty mad at them for getting it so cheap. But if you want to see these indices, Bloomberg has some of them. They're really hard to get out of Bloomberg. On the bond side, you can hit the bond button on Bloomberg and see what comes up, but it's a little tougher to deal with these indices. So those are indices. Most of these are market cap weighted, which means larger companies get a larger weight than smaller companies. The only time that's an issue is high yield. Because if high yield is market weight, what does that mean? Your largest weights can be the companies that borrow the most money. Is that what you want? With high yield? Maybe not. So high yield had a huge pickup in 2007, 2008. When GM went from investment grade to below investment grade, GM went out of the investment grade bond index into the high yield, and GM is pretty big. They became the single biggest name in high yield, and it caused a massive disruption because investment grade investors had to sell GM. High yield investors had to buy it. And it was this big shift because it was so massive. So high yield, I would never buy a high yield index fund. I want someone managing it because I don't want to have my money allocated who's borrowing the most money. That just seems really dangerous to me. But how do you weight an indice? So when the indices first started out, it was equal weighted. You have 500 companies, you put 1/500th in each one. The problem with that is every single day you're out of balance. Unless every stock moves exactly 1% or down 1%, every day you're out of balance. So it's real expensive to put it back into balance. But equal weight is how they started. Equal weight have historically outperformed cap weight. Why? That's because value stocks have historically outperformed growth stocks. If you market weight, you're going to be pushing toward growth stocks because growth stocks are the expensive ones. They're the ones that come up the most. If you equal weight, you'll be underweight on growth stocks and overweight on value stocks. So it's not that equal weighting is a better way to invest. It's that equal weight is a value tilted investment stock. So just realize that. Fundamental weighted, that's been real popular. Lance at Victory Capital, I'm going to try to get him to come speak to Investment Society one of these days. He created the ETFs at USAA, and they have what they call their Smart Beta Fund, which is a fundamentally weighted fund. I should have him come in and talk about it. Essentially what that says is don't weight it by the size of the firm, don't equal weight it, but weight it by some accounting figure like net income or revenue. So you weight it by an income number. Robert Arnott is a champion on that. In fact, if you want a really good article to read, just do Robert Arnott versus Cliff Asness, Smart Beta, and let the controversy start. It's going to be all over the place. These two highly respect each other, so I don't want you to think they hate each other's guts. They highly respect each other. But what Cliff Asness is saying, which is exactly what I would say, is Robert Arnott has not figured out some new way to invest with smart beta. All he's doing is value investing. When you weight by anything other than market cap, you're going to end up with a portfolio that's value tinted versus growth tinted, and value tends to beat growth over time. So Cliff Asness is going to say all that Arnott is doing is value investing.
What's smart beta?
Smart beta is when you weight by something other than market cap. When you weight by accounting measures. So they say it's smart beta, they're saying it's still beta, but it's a smart way to get that beta. So beta means your exposure to the market. How do you want to get exposed to large cap stocks? They're going to say do it by weighting on revenue or something like that. It's a smart way to get your beta. But Arnott's going to say, no, that's not beta. You're betting on value stocks. You're taking an alpha bet. You're betting on value versus growth. So that's the beta. Both of these guys are incredibly intelligent. I've never met Asness. I've met Arnott a couple of times. Arnott is wonderful. I'll read all his articles. Both of them are very, very impressive people. Read their stuff, read their debates. They don't hate each other. It sounds like they do because Cliff Asness loves to throw trash talk out, but they highly respect each other. Really, they're the smart kind of people you should be listening to. All right, let's stop it there.